answering your questions about retirement. It's Money Talk with Michael Eastham.
As a Florida retiree, are double A-rated municipals still better than treasuries in a taxable account?
Municipal bonds and treasury bonds both have a pretty strong level of safety. They're both considered safe instruments. In other words, they have some level of protection. Treasury bonds, of course, are backed by the federal government, and they're backed by the full faith and credit of the United States. Municipal bonds are generally backed by the municipality that issues those bonds. So your level of comfort with the safety is going to be dependent upon the municipality. Now, most of the time people purchase municipal bonds because they hear about them being tax-free. Well, first thing you have to realize is municipal bonds are tax-free. The income, right? Interest is tax-free. However, if you sell a municipal bond before it matures, then you could pay taxes on the gains from the sale of that bond. Both municipal bonds and treasury bonds are considered fixed income securities because they have guarantees of or a contract for interest, and then if you hold the bond to maturity, you get your principal back as long as there's no default. So you have to, again, weigh that. The other thing that's important is that people think that, oh, municipal bonds are very good because they are tax-free. Well, a lot of times people buy municipal bonds because they live in a state where they would otherwise have to pay state taxes, like New York, for example. But here in Florida, if you buy a municipal bond, you only get the federal benefit. You don't get the state benefit because we don't have a state income tax. So very critical to understand that aspect. Now, let's put it in perspective. If you own municipal bonds, or even treasury bonds, well, if you own the municipal bonds, let's keep with just that one particular aspect. You don't necessarily want to have municipal bonds in an IRA or a qualified account because the income is tax-free. You're going to end up having to pay tax if you have it in your IRA, because that money is only tax deferred. So it creates a little nuance that you need to make sure you understand. The other thing that's important with respect to municipal bonds and treasuries, then you have to understand your personal level of comfort with risk, because especially with municipal bonds, many times in order for you to get an equivalent yield on a taxable bond, you'd have to buy a municipal bond that has a much longer duration. In other words, we might be able to purchase a corporate bond that has a little lower rating than the equivalent municipal bond, but we can hold that bond for maybe 5 years or 6 years. Whereas in order to get the taxable equivalent yield on a municipal bond, we have to go out 10 years or 12 years. So that duration risk is something that you have to take into consideration as well when it comes to the types of bonds that you own in your portfolio. So treasuries are going to be taxable interest. Municipals are going to be non-taxable interest. But keep in mind, if you sell a municipal early and you sell it for a gain, you will pay tax on that gain. Hope that helps. Make sure you hit like and you subscribe to Money Talk so that you can catch every episode and not miss a single one. And make sure you give us a thumbs up and pass this along to a friend who may be approaching or in retirement that may have some questions about the same things that you do. Thanks so much.